This morning, I'm fortunate to have my guest. His name is Lane Kawaoka. He is originally from Hawaii. He's an engineer and he's a real estate investor. He's also a podcaster. He's got the Simple Passive Cash Flow podcast, which I highly encourage you to check it out. It's a great resource, and we'll talk about that more with Lane. But with that, Lane, welcome to the program.
Hey Darren, thanks for having me.
You bet. As we were talking before we got on the call, you're currently in Seattle and you're packed up, ready to move back to Hawaii. Is that right?
I am for a variety of reasons. That's where I grew up, and it's expensive there, but with the passive cash flow, it makes things a little easier and great way to wait out the current seller's market, be a little bit more patient in paradise.
Oh, absolutely. Well, I don't know anybody could argue with you for moving to paradise, moving back to Hawaii. That's a pretty good place to call home, I would guess.
Right.
So, Lane, our topic, or kind of our main theme on the podcast is real estate investment strategies. And before we get into that, I wanted to hear a little bit about your background. If you could give listeners, myself, a little bit about yourself and your background.
Yeah, sure. So I graduated college in industrial engineering about 10 years ago. Went to work. Up to that point, I pretty much followed the linear path of going to school, studying hard to get a good job, to buy the house, which I did pretty quickly. I was pretty frugal. Didn't buy the latte like how everyone said to. Very into like all the personal finance blog sphere out there, coming out of college, and I had a job that I traveled all the time. So I quickly saved up for a down payment on a home because that's what everybody said to. Still mindlessly going through like a drone, just following everybody's advice. And I found that I wasn't at that home very much since I was traveling all the time out on Sunday and then back on Friday night. So I decided to rent it out, not knowing anything. So in a way, I'm kind of that accidental landlord. And I was like, wow, this is pretty amazing. That was back in 2010. And then in 2012, the market started to uptick here in Seattle. And then, I was looking to buy another property, and then, which I did. But then I was looking to buy that next property. And then, nothing cash flowed at that point, and I was kind of stuck at a tipping point. And then that led me to the turnkey rentals out of state. And then I did this massive 1031 where I exchanged all my properties in Seattle for to the current portfolio I have now, like almost a dozen properties in Indianapolis, Birmingham, and Atlanta.
Awesome. So you were working the job, getting the W-2, and accidentally became a real estate investor. Was there any thought behind that other than just realizing you weren't there and thought it might be better to rent out your place, or?
Yeah, I had originally bought a Class A with $80,000 down. I think the price was like 350. Pretty nice home back then, 2010. And the mortgage on that was like 1,600, and then the rents that it brought in was 2,200.
Sure.
And the delta right there for someone who doesn't really know anything, it's like at least $500. I mean, that's for a kid in his early 20s, that's a lot of beer money coming in every month.
Absolutely. It adds
Yeah,
up. Or
yeah,
either beer money or it adds up, however you want to do it there.
yeah.
So,
So I'd take a lot of trips. I wouldn't have a home, so I'd go to Las Vegas a lot. And but then during the time, I'd just keep consuming podcasts and books and get into a bunch of other, just expand my knowledge. Because I bought the wrong property. I bought an A class. You don't buy an A class property for a rental property.
yeah, it's probably not the common way,
Right.
although I would argue that a lot of your REITs and your large commercial real estate investors look at it as more of a invest in an A class asset, low cap, but it appreciates more rapidly than some of your other properties. But anyway, that's awesome. I mean, so you got in and saw that and decided to expand on it and just slowly. How long did it take you to grow your properties? You said you've been out of school, what, 10 years?
Yeah, yeah.
Okay.
So at about 2012, 2013, I kind of came around to the realization of cash flow versus appreciation. And I mean, you mentioned earlier, you're totally right. Most people think of investing in location, 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 and appreciation based investing, and which would mean investing in Seattle or San Francisco or Los Angeles or even Hawaii, those high appreciation markets. That's what most investors do, but that's not what the sophisticated investors do who underwrite properties just on cash flow. Because I mean, I didn't go through 2008. I was lucky enough, but I listened to enough podcasts to know that I don't want to be doing that appreciation based investing and not being able to hold on to the asset if something happens.
Right. No, I think a lot of lessons were learned in '08, and as they say, more will be revealed. But and I think there's also kind of a cyclical nature to most markets. Somewhere around 7 to 10 years, I think, is kind of a cycle. So whether you've experienced a lot of appreciation and maybe a correction, and then et cetera. And I think you can follow that in most markets. But yeah, that was monumental, and clearly a lot of lessons were learned there. So I hear you. So let's talk a little bit about what we were talking about before we got on the call. You now have, you said, just under a dozen. You've got, I think you said 11 turnkey rentals, correct?
That's correct.
Okay. And your thinking going forward, what's your thought process for, what's your forward thinking investment strategy?
Yeah, so I got to a point where you pick up the property for around 100 grand with $25,000 down, and you're like, okay, well, it takes a while to do that. It takes 2 months to close on one of these deals, and you've got to submit paperwork and get the Fannie Mae loan and submit DNA samples and everything.
Right.
But but then
Okay.
all that work, and what did you create? I mean, especially with the margins today, you created $200 of cash flow, and it's like whoop-de-doo, right? Like it just wasn't a scalable um, way of going about it. And then I started to go to different networking events where, yeah, you actually have to fly to these things and not just go to that local RIA or go to the internet forum, which I think have the most unsophisticated investors. But I would go to these things, and all these people were saying the same thing. They were seasoned investors with at least a dozen properties too, and they're like, shoot, like we did all this work too, and you only made a couple $100. And then I asked, well, where is everybody going? And everybody's going to the multifamilies. Everyone's trying to get more sophisticated and trying to team up and go bigger. And that's just the path that makes total sense. Single family homes are a great way to start and a prerequisite. And I coach people how to do that, but there comes a point based on your war chest and your trajectory that you need to jump to the multifamilies at some point.
Right. I want to ask you, just as a thought process on the appreciation, how long did it take you to recognize significant appreciation in your first property that you were able to 1031 out of?
Bought it in 2009 and didn't sell it until a couple years ago. But from 2012, 2015, I mean, that was crazy appreciation there. And look, I'll be honest, the appreciation there is total luck. I mean, being in the
Right.
right place in the right time. I mean, Seattle is the hottest market right now in days on market statistics. It's been that way for the last year. There's no doubt that Google, Facebook, all those guys are coming up. The overflow from San Francisco has come into Seattle and Austin and different parts of the country. But the way I see it is, like you're kind of at Las Vegas and you win big at some kind of a prop bet. I mean, you got to take your chips and go to something else. Go have some dinner or something, go see a show, because as you get that appreciation, it can be taken away like that.
Right. No, I think appreciation, and I've always looked at this, and it's kind of the view that I have is kind of more of an ultra long term view. In fact, I remember when I first bought them, my thought was, okay, if nothing happens, if zero appreciation happens, and the thing covers itself at the end of the term, the tenant will have paid off the mortgage. And for me, that was enough of like, okay, that works, because for this little bit of money I can get in, somebody else is like essentially contributing to my 401k. And it's not exactly, I mean, I've clearly changed my view since, but that was Darren's simple way of building a pension plan, if you would, just for a way to make sure that there was something there at the end, as opposed to just the amount of money I was able to put away in my 401k kind of thing.
Yeah,
And,
I just thought it was $500 of beer money.
yeah.
So,
Well, I mean, it depends on where you're at. I guess I was already married and had a mortgage, so it was kind of like how, recognizing some other stuff there. But I think there are, I guess it's this way. For me, it was more a matter of I had a initial long-term view, but as more I get into it and look at it as a business, I recognize that commercial real estate offers that built-in cash flow. And wonder what if you can speak to your kind of comparison of the two. I mean, you talked a little bit about lending, and I love talking about how the lending process on personal or single families is, because it's just like you said, blood, urine, and DNA and all that stuff, and it's just an excruciatingly painful process. Have you borrowed commercially yet?
yeah, so currently I'm kind of building up the resume right now. So going as a key principal as a partner to get that Fannie Mae and Freddie Mac experience. And I think that whole how commercial lending works just never really gets spoken on, those free internet forums or even in discussion in a local RIA. I mean, people just don't get it. The whole reason I went to multifamily was to get that non-recourse lending, because when I started doing this, it took me a while to learn multifamily, and I understood it, but then it did until I figured out that Fannie Mae lends on large properties in increments of $1 million or more to help stimulate the economy, the Class B and Class C asset. Then it totally made sense for me. Like that's where the sophisticated money is going. That they want to incentivize that and give you a non-recourse debt on it. So that means if something happens to the property, you can in theory just walk away.
Right. Well, and I think one of the things that in comparing the two, obviously on the single family, they're looking at you, Lane, and your ability to pay back the loan if a tenant moves out or whatever. Whereas in the commercial, the numbers are based on a business model. You've got your rent less all your expenses. You got your net operating income. And then you've got your cover ratio that the bank's going to underwrite to make sure that you've got enough there to cover their loan. And when you run those numbers at the end, there's supposed to be something left over for you. And I don't know what your thoughts are in kind of running that comparison.
From single family to multifamily.
Right.
Yeah, so single family, they pretty much just look at your debt to income and your somewhat liquidity, and then they don't really know what the property will rent for. So in a way, all they're doing is just looking up title and figuring out if there's if the property will appraise. So yeah, they're doing their due diligence, but nothing in terms of commercial financing where they pull rent rolls, they do all these audits on all the financials. And you're buying a business and they're insuring you with the loan and they want to protect themselves. So they look at it from the business perspective. So a lot, when I first started out, one of my things was, well, if I'm buying this home, at least, Fannie Mae is also looking out for their 80% of this on this deal. But when commercial, yeah, you need to do your own homework, but it's nice to know that they've got their magnifying glasses out too.
Right.
and they're not going to give you a loan in anything less than a 1.25 debt service coverage ratio.
Right. Right. And that's a far cry from, well, I shouldn't say far cry, it's just totally different animal from the single family rental, um, program, and just the cash flow. I mean, clearly Fannie wants a 1.25. And that's just an NOI to service the debt, right?
Right. I mean, that's
And
something when I negotiate with these brokers just off the bat and trying to establish yourself, credible. I run the numbers and I'm like, hey, dude, like this is like a point 0.9 debt service coverage ratio. Like, how is anybody going to get any financing on this, And inevitably somebody's going to come in with cash or, and do
right.
something like that. And it's like, what can you do? That's an institutional buyer. We as investors don't want anything to do with that unless you want a single digit return and you want to sweat bullets in the next correction.
Well, and I just think that if you stay disciplined, I think right now the market's full of cash, and people are looking for deals, and this is kind of when people might do some things they shouldn't, and the more people that do that, the bigger the correction is when it happens, because the correction's happening, whether or not it's, and I don't know who exactly knows exactly what it is. Nobody has a crystal ball, but whether it's an interest rate correction or a world event, or somehow the cash flow, or some sort of monumental movement. I don't know what it'd be, but I think those are probably the things I've talked most with people about that seem to be kind of the looming things as interest rates are creeping up.
Right. Yeah. Like, I mean, a lot of people are saying, there'll be a correction, 50% chance the next 3 years or 6 to 18 months. But the way I look at it, if you're looking at the granular level of, I mean, take a look at some of these apartment buildings in Dallas. Your Class C rents are 750, and they came up from 500, a few years ago. I mean, how much can a guy making 30 grand afford? That's you're pushing the top. I mean, if you're going 750, I mean, the guy can't afford $800. You're
Right.
already maxing that out, and that's you can talk about all what's going in Korea or whatever, or all these worldly events. I don't really follow them too much, but look at can that guy, that blue collar worker, afford that rent? That's where you need to be looking, because a lot of these projections of these syndications I see coming out, I mean, their projections on rent growth, a lot of them that the wrong ones are just using the old numbers.
Yeah, and they're not necessarily paying any attention, like what you're talking about, median income, and just where is that? If it's if you're already getting top rents, and wages aren't going up, how are you going to continue to escalate the rents? Yeah, no, it makes complete sense. Um, Speaking to that, do you have any markets that you're focused on as far as where you're looking to invest in multifamily?
From a national perspective, I think all the major cities and secondary and tertiary markets, if you draw a big smiley face on the United States from Phoenix, New Mexico, Texas, and then do the Georgia and up to the Carolinas, I think that's where all the jobs and population are going. I think the performance indicator is the jobs, and then the jobs bring the population,
Yep.
and that's it. It just seems like everybody's moving south. All the major publications say everybody's migrating south. I don't know if it's for warmer weather or whatever, but just follow the jobs. So me personally, I'm looking at Dallas and Birmingham and Atlanta. Um, all good markets. You probably can't go wrong, I'd say, with any dozen of these major markets like Phoenix, Salt Lake. I think it's not really about emerging markets, as people say. I think it's more about building rapport with brokers and finding that pocket listing.
Right.
I mean,
Right.
it's nice when you can follow the trade winds of like Dallas, Texas, which is probably the hottest market out there. But if everybody else is on there, I mean, it's all about getting that needle in the haystack, and everybody's hunting for that. So different perspective there.
No, I think you're spot on. Um, Talking about your strategy with brokers, can you speak a little bit to comparing that to what you were doing with single family?
So single family, the real estate agents and brokers, they are just pretty much marketers. In the multifamily land, the brokers actually do what you would think they would do, like cold call owners and see if they want to sell. They've got massive lists. A lot of the big brokerage houses they have huge budgets for analytics and data. So they can pull these lists and find out all these metrics to who's going to sell, and they're the ones that are out there finding out who's where the deal is coming from. So I mean, I made a mistake in the beginning looking at the CCIMs, and if your listeners know what a CCIM is, but it's kind of the higher level designation of a broker. So kind of like an engineer, we've got PEs, professional engineering license. It's just a designation saying that, hey, this is the top level broker, which doesn't necessarily mean that they're better, but they went through some higher level education to get that designation. So I initially went to these guys, but now I'm kind of backtracking, thinking that these are the more established guys and maybe quote unquote lazier. They're not out there hustling, not calling, and
Not
they've
as
got their
hungry,
client
huh?
list. Yeah,
Yeah,
not as hungry.
yeah.
So, I'm kind of switching my focus to more towards the go to the website, look at the guy at the very bottom of the website, the guy that sort of looks like he's like an intern,
There you go.
the youngest looking dude out there.
Interesting. That's actually uh, I'm sure that others have found that to be true. Is the older, more established guy has his clients probably not as receptive to calls. Let me ask you about that because I've talked with others about that. Just as far as uh, the rate of call return when you reach out to a broker, can you share with us kind of how you introduce yourself and what uh, when you get one or when one calls you back, or can you speak to how many call you back?
What? So I've tried the emails. I've tried my virtual assistants to contact them. That doesn't really work. That's maybe about a 10% response rate. But yeah, phone calls are probably the best. I mean, it's when you're starting out, you have to qualify yourself because I mean, time is money, and a lot of people will listen to a podcast like this and not really go about the right way or not really know anything. I mean, that's who's buying that. Those are the people who don't educate themselves and don't know what they're talking about and buy a building for 6.5 million where I'm underwriting it for 4.5. I just see that all day, and I'm assuming that a lot of these brokers, it's even worse for them because they're the front lines. They're getting everybody who's interested in multifamily, especially the people who listen to the podcast and they hear us, the dialogue that we have that multifamily is better than single family, but they don't own any real estate. They have no money, no job, and they
Right.
just they just
It's the new lottery ticket. If they just go get in on this, and they'll be set.
right,
Um,
right. There's a lot of programs out there that preach hey, you don't need any money. When you buy the deal, you can just take an assignment fee, and that's your payday. And it's like, well, if you do that, your syndication, I mean, you're just going to take all the returns from the syndication.
right.
And I just don't think that's a sustainable model.
Right. You mentioned syndication. Is that your model going forward?
Yes, I mean, I've looked at a lot of properties in the 16 to under 50 unit range. I know we've probably beaten a dead horse of what the economic how it gets better, buying things in bulk when you get to larger buildings, and after 60 units, you can probably get a full-time property management company to be in the building. But just from the deals that I analyze in that zone from under 50 units and below, I mean, the deals are just way, way worse. And I think that part of it is like every single unsophisticated investor who has, had the duplex, the quad, the eightplex, the 16plex is moving up, and they're the people who are unsophisticated enough to work with other people. So the competition level in that area is so great. And then you add all the other factors of, lack of economies of scale.
Right. Right.
And when in terms of Fannie Mae, Freddie Mac, or other agency financing, the under $1 million loan size and just that level of unit sizes or unit count, it's just like kind of like no man's land. You get the worst financing. If you go to a community bank, they see that as a big liability, and you're just going to pay for it.
Right. Right. No, and I think they all serve a purpose, but you're spot on. I think smaller, it's just less sophisticated. You've got less controls. The property won't support on-site management. So, that's all. It's two different models, and I think
Right.
you're right on about that. So you're doing syndication. You were looking in these markets you mentioned. Let's see what I say. I wrote this down here. Dallas, Birmingham, and Atlanta. Um, have you? How many deals do you think you've analyzed so far?
Um, Probably about at least 500,
Wow.
and I'd say probably the first few months I was doing about almost 100 a month. But that was because I was analyzing everything, and I needed practice. You don't really get it until you've analyzed a couple hundred deals through the analyzer. I mean, initially they take like 10, 15 minutes, but once you get all your windows up on your computer, your P&L, your rent rolls, you can kind of, chug them out quickly. And then you build shortcuts too. There's certain things that I look at, like the current uh, expenses. If I see something that's operating at under 2,500 a unit, I know just to throw that out because that's just, somebody's blowing smoke on those numbers.
Right.
If I see something that's over 4,000 per unit, I know that's, hey, that's might be something going on here because those expenses are pretty high, and that might signal that there's meat on the bone.
What are you seeing as far as kind of a target? You said 2,500 too low, 4,000 high. Where's your 3,000 ish, or what's your?
It depends.
Oops, are you there?
We cut out there a little bit.
Yeah. Oh, there you go. Okay.
Yeah, usually about 3,500 is a good starting point, but the interesting thing that's counterintuitive is that as you get to a bigger building, 200 units, 300 units, that number should actually go up, which doesn't make any sense in terms of, well, if you're getting in bulk, shouldn't it go down, right? But those larger buildings have much bigger amenities. Now you're talking a pool, now you're talking media center, now you're talking about computer labs and just more amenities because those larger facilities, that's the comps out there that they all have them. So definitely counterintuitive and something that kind of caught me in the beginning.
Gotcha. So out of 500 deals that you've analyzed, how many have resulted in a letter of intent or an offer? Any?
Is it you asked how many LOIs?
Yeah. Yes,
I
correct.
would say probably about a handful.
Okay.
I would probably contribute that to, the first 250 or 300. Those are just
Kind of doing the
gar
exercise.
Yeah, a lot of
Yeah.
just is garbage. These guys will just send you stuff, or I'm kind of just pulling stuff.
Right.
But lately I've been on more of a reasonable, 20 to 40 a month or even less. I'm thinking I don't really keep track of the metrics anymore.
And,
I
and
can,
I'm just trying to understand. So for your ratio, so now if you think you do say 30 in a month analysis, would you expect to get one opportunity out of that, or as far as a letter of intent, or how many would you expect?
yeah, so my coaches are saying that I need to put out more LOIs. just because you never know, right? And LOI signal that you're serious, and even if you don't win it, you pose yourself as a buyer who knows how the game is played and can put together an LOI and proof of funds with your management team and partners and your profile, and it just brings you up on another rung on the ladder in terms of who are their buyers out there.
Right. Right. No,
Which again, you don't want to be putting LOIs like how some of these single family home guys and put LOIs at or offers in at 59% face value at every single property.
right.
You don't end up doing that garbage.
Right. No, and I think there's also some value in like you said, is as you put that out there, you make it known that you're a serious buyer. But if it doesn't, uh, you know, generate or produce a sale or whatever, you're holding true to your discipline or whatever your principles are. And say, hey, look, it just doesn't work at those numbers. But if the seller, if that other deal blows up, let me know. I'm here. I'd love to talk to you more about it. I like the deal, but just not at those numbers. And I think that's probably a good place to be, because otherwise I think you set yourself up for overpaying and having a difficult time trying to get out from under a underperforming property.
Right, it's frustrating. I mean, a lot of my counterparts, it's taken them like 18 months to get a deal, and keep analyzing 30 properties. That work equates to an hour or two every single day. And I just don't think a lot of people realize that it's kind of like being a movie actor in Los Angeles. You just got to keep putting in the work, and
Right,
it's not
right.
a get rich quick thing.
Well, but I think though it's in the doing that you really kind of are able to recognize an opportunity. It's as an engineer, I'm sure you understand. Math. It's you don't learn it just by reading it. You have to do it. And do it and do it and do it and recognize how the numbers work and how they relate. And I think the more that you familiarize yourself with that, the more easy it is for you to identify something that has potential, like you're saying. If your expenses are out of whack or underestimated, and give you a sense of really how the numbers work, to where you can be disciplined, to where when you make that offer, everybody knows it's going to work for you, it's going to work for the bank, the broker knows that you're a mindful investor, not just somebody full of cash looking to make a deal.
Yeah, I think the mind
Oops,
jumble, but
you there?
oh, there you are. Yeah,
Yes.
so I was saying the mindset is probably one of the most important things, which I always thought was mumble jumble before. But to be able to stick in it and seeing the positive that has come out of this, I mean, look at all the deals that I bought that I would have bought if I didn't know what I was doing, that I would save myself.
Right, right. No, and I think especially in this market, as more and more people continue to bang the drum of real estate investing, and more people are looking for an opportunity, and the newbie investor is just so eager to get in. If they don't establish a criteria and have a thorough understanding of how it works and how it can work well and how it can not work well. And I can tell you, as a 20 plus year investor in more of single family, recently moved into multifamily. I've bought in high markets and I've bought in low markets, and always I've done much better when you buy in a low price market. But in single family it's different too, with the interest rates kind of dictate a lot of that price. I mean, a lot of pricing is based on what, again, people can pay monthly. And if interest rates are low, the price goes up because they can pay the same amount, but that multiplied by a lower rate gets a higher number. So it's kind of manipulation there. But well, Lane, I'm kind of looking through what I wanted to talk to you about. Is there anything that we didn't touch on as far as your kind of your realization between the single family and the multifamily? What you're finding there that we should have that I should have asked you?
Yeah, I think a lot of people start off like myself, if a working professional, don't really have the time to do it full time. So a lot of people start with private money lending or turnkey rentals or a rental home near their home, maybe a small multifamily. Um, but not a lot of value add because you just don't have the time, you don't, or nor the experience to go out and carve out distressed property. But the jump to multifamily, the reason you're doing it is for to bump up NOIs and properties and create that forced value. So there's a different, totally different business plan change from single family that I did. I did mostly stabilized properties. In fact, they were all stabilized. They all had under $5,000 of rehab when I purchased them. But the multifamily is you're buying something that's stabilized, that's kicking out cash flow, and you're buying it with that value add component. And I think right now with a correction coming up, having that value add component, if something happens and everything drops 20%, well, you can still do the value add component and you can still stay above water. So I think now is the time to not be buying stabilized properties, but to be buying these properties with that value add component, whether it be, you can do assigned parking and you can raise an extra few grand a month, or you have undervalued rents, or you can start charging rubs, or you can start charging coin laundry. I mean, those are the things that in your back pocket you can increase the value, and in a way that's your safety net. So that's my pitch for multifamily.
I like it. Lane, what's the best way for listeners to find out more about you and get in touch?
Yeah, you guys can go to my website, simplepassivecashflow.com. I've got a bunch of podcasts there. You guys can follow my story. I still talk about my single family rentals since more to inspire people that you need to start there before you go to something bigger. So I talk about a lot of the pitfalls and what I'm going through in my portfolio and how I deal with it. And we've got a book there, How to Buy a Turnkey Rental, that I'm gonna come out with soon. So you guys can get free access to that if you guys go to the website and sign up.
Got it. Well, Lane, appreciate you making time for us today. And I look forward to talking again soon. And also, best of luck on your move back to Hawaii.
Yeah, it'll be a nice place to hang out while I look at all these properties that are 20% overpriced
Yeah,
and listen. It's nice to listen to broker talk while you're sitting at the pool.
yeah, I'll bet. So, well, thanks again. And for our listeners, if you like this show, share it with someone you know. It's real easy to do. You can hit the share button, and you can share Lane's information here. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.